The United States Department of Treasury is responsible for federal finances. It comes up with the government's budget and how it will raise money to pay for those expenses. Congress created it in 1789. It is two divisions: departmental offices and operating bureaus. The departments are mainly in charge of policy making and managing the Treasury. The party happens on the other side, the operating bureaus. Number one, Internal Revenue Service, or IRS. We all know what that department does. Number two, the Bureau of Engraving and Printing, or BEP, in charge of printing and minting all U.S. money. And number three, Office of the Comptroller of the Currency, responsible for safeguarding the federal banking system. Although it's the Treasury Department that's responsible for creating the budget, federal legislation authorizes spending levels. If the government spends more money than it receives, that's when we run into a deficit. So what does it do? It borrows money from the public or from other government agencies. It wasn't always like this, though. Up until World War I, Congress had to approve each instance of the government wanting to borrow money. Congress decided on the number of securities that could be issued, their maturity date, and the interest that would be paid on them. The Second Liberty Bond Act of 1917 granted the U.S. Treasury borrowing authority for as long as it stays within the ceiling that Congress sets. The Treasury was also given the discretion to decide maturity dates, interest rate levels, and the type of instruments that would be offered. When the debt ceiling is reached, the Treasury Department must find other ways to pay expenses. However, the debt ceiling has been raised several times, the latest of which was last year when Congress approved a $2.5 trillion debt limit increase. One way they do it is by selling treasuries. Treasury bonds are fixed income investments issued by the U.S. Department of Treasury. When you buy a bond from the government guarantees that they will pay you the interest in regular intervals or when it matures. They are the safest investments in the world since the U.S. government guarantees them. This means they are low risk, but they also have the lowest interest rates of any fixed income security. So what are the differences? It's the length of maturity. Treasury bills are issued for terms of less than a year. Treasury notes are issued for terms of 2, 3, 5, 7, and 10 years. Treasury bonds are issued for terms of 30 years. Treasury inflation protection securities, TIPS, have different terms, 5, 10, and 30 years. The Treasury Department increases its value if inflation rises. You can buy treasuries three ways. A non-competitive bid auction. If you're willing to accept any yield, this is for you. This is the method most individual investors use. They can go online to treasurydirect.com to complete their purchase. B, a competitive bidding auction. If you are set on a yield rate, this is for you. You must go through a bank or broker. C, the secondary market. This is where Treasury owners sell the securities before maturity. The bank or broker acts as a middleman. Are treasuries a good investment? Like any other asset, there are pros and cons. Treasury bonds, notes, and bills are all types of U.S. government debt. Bond refers to debt with a maturity of 10 years or more, while notes are issued for terms of 2 to 7 years, and bills cover obligations that are payable in a year or less. Regardless of the name, all Treasury securities are backed by the full faith and credit of the U.S. government that effectively eliminates default risk. Because the government can always mint new money that it can use to repay Treasury debt. Another key advantage of Treasury securities is their liquidity. The market for treasuries is large and extremely active, making it easy to buy or sell Treasury bonds, notes, or bills in whatever quantities and maturities you want. Moreover, the Treasury consistently sells new Treasury securities at auction, and the public can participate to buy treasuries directly from the government without going through a bond broker. Despite their advantages, treasuries are not the perfect bond investment for every investor. One problem is because they are seen as the lowest risk bonds in the market, their yields tend to be relatively low. By contrast, corporate bonds typically carry higher interest rates, offering the potential for investors to get more income from the same principal investment. The higher yield compensates investors for taking on the risk. that a corporate issuer will default on its debt obligations. Treasury securities are also subject to many of the same risks as other fixed income instruments. If interest rates go up, then Treasury prices will go down. And in general, the longer the maturity of the Treasury security, the greater the drop will be. That means that Treasury bonds have the greatest interest rate risk, with notes having somewhat less and bills have little or no exposure. Similarly, for foreign investors, currency risk is involved because treasuries are all denominated in US dollars. For bond investors, Treasury securities carry a reputation for being the safest way to invest in fixed income. Even though they have their trade-offs, Treasuries can make a good addition to most balanced investment portfolios. I personally diversify my portfolio. I have high yield, high risk investments, medium risk, and low risk assessments. Since Treasuries are backed by the government, it is low risk but also low yield. I have that under low risk assets. It isn't the majority of my portfolio, but it is part of it. I'm interested to hear what assets are in your portfolio. Let me know in the comments below. This has been Ivory Hecker for Noble Gold News.